All right, so got another little exercise here we're going to look at. Budgeted income statement with cost, volume, profit analysis. And this is a lot of these figures in this particular question are provided to us. And so we don't have to do a whole lot to get most of this correct. I suspect that only part B down here at the bottom might cause us a little bit of difficulty. Everything else is very, very simple because they practically hand us the answers. So we have to fill all of this stuff in. And so let's just see here what we've got, and you'll see what I mean. It says Madison Booksellers is planning a budget for 2018. The estimate of sales revenue is $3.2 million. Well, an estimate, a budgeted income statement is an estimate. So all we really have to do here is just drop that figure in and we'll have it. And it says, and cost of goods sold is 70% of sales revenue. Okay, so we've got that 3.2 million, and then we're going to multiply that by 70% to come up with our cost of goods sold figure. Okay, and then gross margin is merely those two numbers. It's not a negative, I just got lazy. Okay, and so we've got all of that done. And let's see here. What else do they want? Depreciation on the office building and fixtures is $120,000. Salaries and wages are budgeted at $200,000. Advertising has been budgeted at $180,000, and utilities amount to $140,000. Okay, so it looks like all we're going to have to do here is just plug these numbers in. And so if you were already working on something like this, you would probably already have this part done. And then what were utilities? 140. Okay, so let's see here. That's 120 plus 200 plus 180 plus 140. Okay, and then add 3 zeros to that. So looks like our total operating expenses are going to be $640,000. We're going to end up needing that number. Do note that we've got a combination. We've got a couple of fixed operating expenses and depreciation and advertising. We have a variable amount, or probably a mixed amount because it's wages and salaries. And then we have another mixed amount, utilities. So combination of variable and fixed expenses here. And then net income before taxes, we can just simply take the 960 minus the $640,000 in operating expenses. Okay, and income taxes, what they do. It says income tax is estimated at 40% of operating revenue. Okay, so just take the 320. This net income before taxes, we don't have any peripheral items, so that actually is operating income. It ends up being the same here. Let's see, they only say use a negative sign only to indicate a net loss. Okay, so we're not going to put a negative sign in here either. And then our net income is going to be 320 minus 128,000. And that's going to give us 192,000. Okay. So assuming that all of that's right, and I have absolutely no idea how it wouldn't be, that was pretty basic. It says, assuming management desired an after-tax profit of 210,000, determine the necessary sales volume. And notice that we have a dollar sign here. So when they say sales volume, they mean dollars. Okay, I think that's obvious. So they want an after-tax income of 210. Notice that we already have an after-tax income of 192,000 based upon $3.2 million in sales. So we have to recognize that whatever our answer is going to ultimately be, it will be some number that is bigger than 3.2 million. Does that make sense? All right, so assuming that we understand that our answer is going to be a little bit more than the 3.2, essentially what we're going to need to do is we're going to kind of work backwards. At least that's how I'm going to do it. So if we were going to do that, what we're essentially saying is that we want to replace this 192 with 210,000. So I'm going to work backwards. So I'm going to kind of pretend that my 210,000 is already there, and I'm going to say, okay, how did I get there, right? So I'm going to take that 210,000 and I have to first account for income tax because I'm trying to get to the equivalent of this 320 here. So what I want to do is I'm going to divide it by 1 minus the income tax rate. Income tax rate is 40%. So again, divide by 0.6. How do I get 0.6? 1 minus the income tax rate. So if we think about it, if I were to plot 350 right here and then multiply that by 40%, I would come up with 140,000. Then I would subtract 140,000 from 350, and I would end up at 210,000. But we're going kind of backwards here, right? So instead, I take the 210 and I divide it by 1 minus 0.6. All right. So I've got 350,000. Then what I'm going to need to do is I'm going to keep going backwards, and I'm going to simply add my operating costs here. So a little bit of an assumption that is taking place here, but that's okay. $990,000. And then notice up here, now we're nowhere near 3.2 million yet. We're going to have to account for cost of goods sold. And just like we did with income tax, where we took 1 and we subtracted the income tax rate, what we're going to do now is we're going to take 1 and subtract the cost of goods sold percentage, which they provided to us as 70%. So 1 minus 0.7 is 0.3. So all we do then is divide by 0.3. We get 3.3 million, and this is probably going to be a correct answer because we already acknowledged that our answer was something more than 3.2 million. And so if this is, okay, it is right. I knew it was going to be close, and fortunately, that worked out. All right, so again, I think you could have handled all of this. This was the only one that I was a little bit concerned with. So we'll close this video out and start another one. Yeah.